Hey guys, JC Peretz here, and welcome back to the podcast. On today's episode, I sit down with Ed Clissold, Chief U.S. Strategist for Ned Davis Research. I've been a huge fan of theirs for a long time. This is a great episode where we get into market breadth, seasonality, sector rotation. We talk about everything from stocks to bonds, commodities, currencies. I think you're really going to enjoy this one. Let's get into it. All right, Ed, so I've been following you on Twitter for a long time. Willie Delwich here on the team is a big fan of yours. I've been a big fan of everything Ned Davis does and has had to offer forever. So it truly is a pleasure having you. Welcome to the podcast, Ed.
Great to be here, and likewise, fan of you guys' work. And yeah, Willie and I go way back, and so glad he's with you guys and looking forward to the conversation.
Yeah, Willie's been a great help because Willie has a lot of experience with financial advisors. We have some experience. I like to think that I have a lot of experience with financial advisors, but Willie just blows us out of the water. So definitely a good guy to have on board. And then what about yourself? You've been at Ned Davis now for what, close to 20 years?
Yeah, exactly. 19 years to be precise. And actually, I got my start in the business at J.C. Bradford, which was a regional brokerage firm based in Tennessee, which is where Ned Davis was before he started. So I knew of Ned, and when I was there, he was this demigod at J.C. Bradford. And so when for those who follow all the financial acquisitions in the 90s, we were acquired in 99 by PaineWebber, who immediately sold themselves to UBS. And so then I went to business school and came to NDR, and it's been a fantastic experience. I have a CFA and an MBA, but I consider myself a practitioner when it comes to technical analysis because I'm surrounded by some fantastic CMTs. And of course, Ned is viewed as a pioneer in technical analysis. So we get to apply the fundamentals and the technicals to what we do.
When we talk about Ned Davis and just what an inspiration he's been to me and a million other friends of mine, just the title of his book, let's say you don't even want to read the book, just read the title, Being Right or Making Money.
Yeah, and it makes you chuckle because you read it. My reaction when I first saw it, was I was a client at the time, was of course. But then once you get into the markets, particularly if you're selling research, that you try not to fall into the trap of being right, of saying, I got this call. Did you? When you say you got it right, were you 6 months early? Well, right. Congratulations. What was your drawdown? Right. And Ned even talks about that in his book about the beginning of his career. He felt like he was quote unquote right, but he wasn't making as much money. And then if you follow the trend, and you can have these concepts, these theories that you're working on, or these ideas, but if you stay on the right side of the trend, it's going to help you make money, and that's what we're in this to do. And so keeping that in mind as you're investing is so important. And as long as they're human beings trading, it's going to have to be something you keep in mind.
I see it on both sides. You're like, oh yeah, we're shorting Apple. And then like 3 months later, it's going to be like, oh, you idiot. Remember you were shorting Apple? It's like, no, I barely remember. I think we got stopped out 3 days later. Like I have a vague recollection of the whole thing. It's a miracle that you still think about it. Because again, it's not about being right. It's about making money. And then on the complete opposite end of the spectrum, when we're trying to come up with ideas and we're strategizing, we're looking for favorable risk versus reward opportunities. That's really what it is. And being on the right side of the trend helps increase the probabilities of success. So if you could do that and then skew the risk reward in your favor, and you could do that consistently, it's going to be hard not to make money, isn't it?
Yeah. So there's a couple corollaries to that. Keep your losses small, let your profits run, which again is probably against most people's nature. If they, the intuition is to double down so you can eke out a win, or if you're up a lot, you think, oh, I want to go ahead and lock that in, but that's not how the markets work. And then also you think about if you can use history as a guide to look at the risk reward, and market returns are not normally distributed. You can't think of a bell curve when you're doing the analysis. I think it's another trap people fall into. They look at some statistical numbers and think, oh, this is a significant event, therefore this should happen. Well, markets aren't like that in real life. But if you can find some information historically where you say, okay, 18 out of 20 times this has happened. Or when X has happened, the market has rarely been down 6, 12, 18 months later, then you feel like the risk reward is really in your favor.
And you mentioned something and you just glossed over it, because you and I think we take this sort of thing for granted, is that markets don't fall. They're not normally distributed, the returns, right? They don't fall in that normal bell curve. So when it comes to investing versus gambling, all of those comparisons just go out the window. And correct me, and I want you to expand on this, but correct me if I'm wrong. The fact that market returns are not normally distributed, and we know for a fact that markets trend, that's why technical analysis works, because that's what we're doing. We're looking for trends, aren't we?
Yeah. And so when you talk to maybe somebody who doesn't follow technical analysis, they might, some people may think of it's voodoo or something like that, but and it gets so they don't want to believe it, they don't want to believe in it. But then one of the comments I get is, everybody sees this information, then why is it valued? Say everybody knows the S&P is above its 50-day moving average, so why is it valuable? As just an example, and the reason is that markets trend. And as long as humans are involved, these sort of things are probably going to be around. And so I think what I see some people do is get too comfortable with doing some of these back tests and trying to quantify everything and saying and having a false sense of comfort, because once you turn off the back test and you go real time, anything can happen.
Right.
And that's why, so that's where I think technical analysis can be helpful, because the best laid plans can work against you. Or as the cliche is, we'll do whatever it has to do to prove the majority wrong. So you have to be ready for that.
You mentioned if everybody's looking at the 50-day moving average and everybody knows that the S&P is above the 50-day moving average, sort of alluding to that self-fulfilling prophecy, which I imagine you might get thrown your way every now and then. What do you tell those people?
First of all, nothing's going to work all the time. But if you strictly were talking about stocks, there is an upward bias to equities over the long run. Depending on the time frame you want to look at, the S&P 500 is up 5, 7, 9% per year, depending on how far back you want to go. So you have that working in your favor. Just make sure you stay on the right side of the trend, because we don't know when the trend is going to end. And then let your profits run. And then when the trend breaks, then you have the discipline to get out of it, to make that sale, or hopefully that means you're taking profits and not trying to wait and top ticket and to think you're the genius who's going to get out.
So we were emailing back and forth prior to the podcast, and I was surprised at what you said, that your number one technical question you were getting right now has to do with seasonality, because I was going to ask you about that, because you guys do excellent work creating a composite between the seasonal cycle, the presidential cycle, the decennial cycle, bringing it all together, overlaying the current data. Like, you guys do a heck of a job with the visualization. I'm a little bit surprised that it's the number one technical question you're getting, really?
Yeah, and I think there's two reasons for that. One, and probably the biggest one, is what's going on right now. So we have the cycle composite, which, as you alluded to, it looks at the pattern for the S&P 500 over the 1 year cycle. Then we look and we add in the 4-year cycle, such as post-election years, and then the 10-year cycle. So in this case, years ending in 1. So if you put those together, it shows a market in an uptrend into August, September, and then a pretty decent pullback and a weak year-end rally. So right at that point when we're going from a seasonal tailwind to a seasonal headwind. So I think that's part of it. But I think the other thing is that people want to know what's going on behind it, which is a fair question. Why do you choose what you're going to do? And there's a rationale behind each of those, 3 time periods. If you look at the 1 year cycle, there are times of the year for tax purposes when there are more inflows into equity mutual funds and ETFs. People do it toward the end of the year. They get year-end bonuses. And usually stay strong in the beginning of the year up until tax season. People may be putting money into IRAs right before they pay taxes. And then you get into the fall, and some mutual funds have their tax events that people may not want to be buying as much. So, and then also there's a seasonality to stock offerings. Wall Street likes to go on vacation in August. There's not a lot of stock offerings. They come back after Labor Day, so you have more supply of stock coming on right when there's not as much demand for stock. So that's a reason why the fall corrections tend to be the biggest ones of the year. In the 4-year cycle, there's a rationale behind that too. If you look at government stimulus, they usually really ramp it up going into the presidential election and then take it away in the post-election year. And they start to ramp it up again a little bit before midterm. So the period toward the end of the post-election year into around the middle part or so of the midterm year tends to be the weaker part of the stock market cycle. And then the 10-year cycle, that one, again, you get a lot of questions over, what does the 10-year cycle have to do with anything? But if you look at economic returns by year, years ending in 1 are the second weakest of the 10-year cycle for economic growth. So it makes sense that stock market returns are also pretty weak in years ending in 1. So, there's something to the economic cycle except for, of course, if you don't have some sort of shock, say oil embargo or, I don't know, a global pandemic or something like that. Right. It's going to throw the cycle off. But so of the 3, I think the 10-year cycle may not make as much sense this year because, again, this is going to be one of the strongest economic growth years we've seen in decades.
Right, because what's the denominator?
Yeah, you're coming off of such a steep recession. But yeah, so you'd expect market returns maybe to be better than your average year 1. So you have, of the 3 components, 2 seem to line up pretty well, the 1 year and the 4 year, 10 year, not so much. But so we explain all that and come to the conclusion that, seasonality is getting pretty weak here. Maybe not as quite so terrible as the cycle composite implies, but there's going to be some headwinds going into the fall.
So let's talk about market breadth. I look at quite a few charts throughout the week, to say the least. And, I noticed things like the NASDAQ advanced decline line peaking in February, emerging markets peaking in February, the IPO index peaking in February, biotechnology peaking in February. When you go through all 500 S&P stocks or even a lot of the Russell 3000 stocks, what do you find? You see a lot of peaks in February. Then you had a bunch of cyclicals that continued to make new highs, and you had a lot of them peak the second week of May. So you had a lot of names peaking in the second week of May, and then really just deterioration since that peak in February, since that peak in May. And what I've been saying is that most stocks have not been doing well. Some stocks have been doing well, but most have not. And that's really been our approach to markets, is within that framework. You want to touch on that? How do you feel about all that? Where's your head?
Yeah. So first of all, everything you said is accurate. And this is where I get the benefit of technical analysis. It's not opinion. Everything you said is true. So there's no debate there. I think what I probably have a little bit more of a positive view of the breadth picture for a few different reasons. One is percentage of stocks above their 200-day moving averages is still pretty healthy. And so now for stocks that fall below their 200-day, they have to first fall below their 50-day, and then they'll fall below their 10 days. So if you start seeing the deterioration, you have to keep an eye on that. We found that even the 50-day moving average of stocks for their 50-day, that can move around quite a bit. And so we don't get too alarmed if you see that happening. The second thing is that, as you alluded to, we had the cyclicals peak out, but what we've seen lately is that the growth names do better. And one of the hallmarks of the bull market that started in March of 2020 is that no one group has gotten too dominant. You get the stay-at-home stocks doing well, and then the reopening stocks pick up, and vice versa. Had several different cycles of this.
Rotation. You're seeing rotation.
Yeah.
And who said it, right? Sector rotation is the lifeblood of any bull market. That's how I learned it.
Yeah, exactly. It's a great way to put it. So you have these rolling corrections underneath the surface, but the popular averages can do okay. Now, at some point, that's not how it's going to go. One group is going to completely fall off, and then you're going to be left with the other groups being the only ones holding up the market. And then when they run into trouble, then you get the bear market. So we just haven't. we haven't seen enough evidence that kind of narrowing is happening. And so we have an indicator we call the Big Mo Tape Composite, which is a funny name, but it's a percentage of sub-industries and uptrends. And that's been hanging in there. It's in the upper 50%, over 50% of sub-industries are still trending higher. So that's still doing.
And how many do you include in your universe there of sub-industries?
Yeah, so there's about 110 of the 150 or so are in it, because some of them don't really predict the overall market.
I was going to say 130.
yeah, exactly. Yeah, but you understand,
sure.
Like there may be some sub-industries that kind of beat to their own drum, which is fine, but they're not going to be very predictive. I'll throw one more thing out there, which is just a little confounding, is that we track two NYSE AD lines. One's common stock only, and one includes everything that's on the exchange. It could be a bond fund or whatever. The common stock only AD line peaked several months ago, but the one that includes everything made a new high just a couple weeks ago.
Yep.
And that's just it. If that tells me that maybe things aren't quite as bad as they have seen. But to bring it back to your first comment, breadth is not as good as it was several months ago, and that definitely warrants attention.
You talk about the rotation underneath the surface throughout this deterioration in breadth. We talked about the February peaks, the May peaks, but the rotation, you can't ignore that. It's just been so blatant and right in front of us. And then what that brings me back to is this thought of the year two of cycles. When we have these initial monster thrusts off year one, and I want to talk to you about thrusts because I know you guys do great work in that. But when you have the 2009 bottom and thrust, you've got the 2020 bottom and thrust, that initial thrust in 2003, the initial thrust in the early 80s, the one in 74 going into 75 and 76. What ends up happening, 76 was a choppy year. 2004 was a choppy year. 2010 was a choppy year. So we've seen that chop before, 2004 choppy. And what are we seeing this year? It's pretty choppy. Seems pretty consistent, no?
Yeah. So if you look at the second year of bull markets, the gains tend to be a lot smaller, and part of that is that just the mean reversion, or the stocks being so oversold, during that first year, that it's just coming back to some sort of long-term trend, and then once you get past that, then things normalize.
It's a digestion, right?
Yeah. And I think there's also something going on. It's not really technical analysis, but if you look at what's coming out of a recession, that first year, investors are pricing in, things are getting better. But then once you get into that second year of an expansion, usually there's a steeper correction. So in fact, if you go all the way back to the 1960s, on average, there have been 2 bear markets for every recession. Okay, so the bear markets that overlap with recessions, those are the worst ones, right? Down 37% on average, and because everything's going bad with the economy and earnings are collapsing, et cetera. But you come off that low and you enter, and actually the market bottoms on average about 4 months before the end of the recession, because markets start to look, they're always forward looking. But once you get when the median is 16 months into that, what we call a post-recession bull, as this digestion takes place and investors start looking at the fact that you're not going to repeat the economic growth numbers you've seen, you're not going to see the earnings growth numbers you've seen, you get more frequent corrections, and on average, you get a shallow bear market 16 months later, which would put you about now. You think that the bottom was in March of 2020. Now, that's the average. The median means half of them lasted longer. So if you go off to 2009, by our definition of bull and bear markets, actually 2010, there was I think a 12% correction in the S&P, but that's not a bear market. We got one in 2011 that did meet the criteria for a bear market. So that was a little over 2 years later. So again, this doesn't mean we're going in a bear market now, but it means we're getting into the phase when you're going to get more frequent corrections, and some of them can turn into something a little bit worse. Now, if you're a longer term investor, do you think you can handle a 2 to 3 quarter correction that gets close to 20%? If the answer is yes, then then this maybe is not something to get overly concerned about. Now, that's always, again, that brings us back to what we talked about at the beginning. That's easy to say. Then emotions take over when the market's down 12%. You think, do I want to? Am I really going to hold on? But yeah. So to this part of the cycle, we are at a part of the cycle where you would expect the technicals to start to look a little bit worse, and they are.
And when you talk about the rotation coming underneath the surface, and you're talking about that slight bear market-ish, messy environment, call it what you want. And sure, it seems that way. In all those other sort of year two scenarios, that they turned out to be springboards for future gains, right? The 80s were great. 05, 06, 07 was great. 2012, 13, 14, 15, maybe into 14, maybe not so much 15. But right, you had the late 70s. Those were good times for stock investors, weren't they?
Yeah. So it's a good point. So the cycle, we talk about recessionary bear, post-recession bull, and then you have the shallow bear market. We call that really an echo bear, because it's really a reverberation of what happened during the recession. And then you go into this post-echo bull, where maybe the pace of gains isn't as great as they were coming out of the recession, but you're still going up about over 20% per year on the S&P, and it tends to last a long time, usually until the next recession comes along. That last cycle, because that expansion was actually 11 years long, we actually got a second non-recession bear in 2015, 2016, but still it was fairly shallow, and then you went on for another nice run until 2020. So the risk is if there's a double dip recession, which has only happened once in the last 70 years, which was 80, 82. Now, the pandemic, of course, don't want to make any predictions about what may happen in the future when it comes to the economy. But again, if you look at previous cycles, double dip recessions in the U.S. are pretty rare.
Ed, my suspicion is if we are going to have a recession, price is probably going to give us a heads up about that, huh?
I would think that would definitely be the case. Yeah. And I tell you, one thing that keep an eye on is the Russell 2000 versus 1000. That's the small caps tend to sniff these things out. And Q4 and Q1 were the best back-to-back quarters for the Russell 2000 versus the Russell 1000 ever, going back to the late 70s when the Russell data started. And Russell 2000 is given 2/3 of that.
It had a heck of a run. We've seen that underperformance. Is there an interest rate story there? Because when I overlay that small cap, large cap ratio with the 10-year, man, they look awfully similar.
Yeah, I think there is. Small caps are economically sensitive, and they would benefit. So then, as the economy does better, rates do better, and you think small caps would fall in line with that. Yeah, so there's probably there's an economic message underneath the surface, and I think that also gets to maybe why breadth has not been as strong lately, because those 2,000 stocks in the Russell 2000 small cap index, and only 1,000 in the Russell 1000 large cap index. Small caps are not doing well. The breadth data is going to look worse.
Also, the best small caps get kicked out, so you lose your best players all the time.
Yeah, it is tricky, which is why I think that the S&P indices may be a little more stable. For those you like to follow the different indices, Russell does a screen every year, and there's a little bit of bandwidth in there where maybe not every stock may move back and forth as much as it used to, but basically, your top 1,000 or 1,000, 1,001 or 3,000 Russell 2000, whereas S&P uses a committee. They try to get a good sector mix in there, so maybe things booted out as much. But that's also another reason to look at mid caps. We like them because they don't get caught up in a lot of that stuff.
My whole career, Ed, I've been told, we talk to the old timers, right? They all tell you the biggest winners of my career came from the mid caps. And I've noticed that myself, maybe because maybe I pay a little more attention. Like when we have winners from mid caps, see, there's a mid cap, there's another big one. From a philosophical standpoint, just think about this. You got mid cap stocks, meaning they've already graduated from small cap. They're crossing over that 2 billion threshold. You got to, unless it's an IPO that debuts as a large cap, which these days happens all the time. But if you go through a more traditional route and you're going to 2 billion, 5 billion, 10 billion, 30 billion, the beauty of these mid caps is that they can double, triple, quadruple, and they're still not that big.
Yeah, you get the sweet spot, don't you? Where they're big enough where they maybe aren't going to be subject to all the as much of the economic headwinds, but they're small enough where they haven't completely dominated their space yet. And there's actually less money tracking mid caps than even small caps. You look at assets and ETFs and equity mutual fund. Yeah, there's a sweet spot. And even if you go back to when the Russell data started in '78, if you look at the best of the three, so Russell top 200, Russell mid cap, Russell 2000, the best one each year is roughly one third. Like if you look at which one's been the worst, the mid caps have only been the worst 5 times.
Wow.
In that whole time. So when small caps are getting crushed and the market's going down, mid caps stay up. And then when large caps are doing well, small caps are doing well, they participate some.
Yeah.
And so what's the rule is first way to make money is not lose money. Mid caps are a way to do that.
The Jan Bradys of the world. Don't forget about them.
Yeah, I've not heard that one. That is fantastic.
The kids these days, they don't know what we're talking about, Ed. They don't know what.
Marsha. Yeah.
All right, listen, hard pivot here. Hard pivot. I want to talk about thrusts, momentum thrusts, breadth thrusts. What does that mean to you?
Yeah, so funny term, but it means when a bunch of stocks move up together at the same time. And that's positive because if you get a lot of stocks with strong momentum and a few of them start to peel away, you still have a lot of other ones with that momentum. And so that means the popular averages are more likely to continue to trend higher. And you can measure them lots of different ways, but percentage of stocks above their 10-day moving average is one of them. You can look at advancing volume versus declining volume. So all the stocks went up on the day, what's their volume? All stocks went down in the day, what's their volume? But if you get really high readings on any of those, you look out 3, 6, 12 months later, the market returns versus the long run averages are quite strong. And very rarely is the market down 1 year later. And so they are some of the most consistent indicators coming off of a low. And it's it's more common to get those after a big decline because the markets are oversold, right? So it's easier to get that snapback. Sure. And they do a good job of telling you maybe the decline's over. And we even got that in 2020. The low, it was, I think, on the 23rd, and I think the 26th, we got our first breadth thrust, and you got some confirmation a couple of weeks after that. And so it's a pretty compelling indicator, especially when you get 2, 3, 4 of these breadth thrusts firing at the same time. It's a pretty strong message.
And then what about to the downside? What about like when you get like the most amount of, I don't know, new 52-week lows or stocks getting oversold, like huge expansions and that? Can you make the same argument the other way? How do you view that?
It's not as consistent. I think at the beginning of a decline, if you see expanding new lows, which again, that's something we're starting to see a little bit lately, that tends to be negative. But if you get like a huge print, that's actually more of an oversold reading and maybe a sign that selling's getting exhausted. But you still want to wait and see the breadth thrust on the upside. So, for example, in 2008, which was just such a horrible series of downdrafts, you'd get these oversold readings, but then you think, well, how can the market get more oversold? And then it did. But yeah, so that's a little bit of a mixed bag, and I think that gets back to the fact that the market trends higher over time. And so it can be almost a so bad it's good situation if you get a really bad breath.
One of the things that has kept me and the team in the camp that any messy sort of digestion year that we're having in 2021, which I think that mess really got going in the second week of February and got worse in May. Maybe things are getting a little bit better in some cases, but not really. We could probably all agree that for the most part, the average and median stock has been pretty messy for the majority of the year. But to me, it all falls within the context of something bigger, larger, and more bullish. And 2 charts in particular that really stand out to me are the Euro Stoxx 600 that did nothing for 20 years and recently broke out, and the US S&P financials that did nothing since the '07 peak, went sideways for 14 years and recently broke out. It's hard for me to have a structurally bearish outlook towards equities if Europe and financials are breaking out of bases that massive. Can you touch on that? What are your thoughts on?
Yeah, no, first of all, I'd agree with you. Some of those European benchmarks, even before the pandemic downdraft, had barely made any headway in this entire century. So to get a breakout in those stocks is very positive, and financials too, though not as long. But even you saw that, say, from tech after the .com bust. It took a decade for them to base, and of course now they're leaders again.
But on a relative basis, we're still nowhere near those highs, right?
Yeah, relative base. Yeah, so there's more room to go. But so if you get a really long base like that and you break out, normally there's a long period of outperformance left. So that's a really positive development, I would think.
And important areas. We're not talking about like materials, like we're talking about financials,
Yeah. And they're doing this with the 10 comfortably below 2%, under 1.5%. So imagine if the yield curve steepens a little bit, how much money that they could make. And so, yeah, these are all good developments where you'd think that markets can correct. I mean, you have to work through this digestion, as you said, but the long-term prognosis appears to be pretty positive.
I want to talk about the growth versus value. You mentioned that you've been getting asked about that a lot. We certainly have. When you look at the recovery that growth has seen recently relative to value, you're not seeing that when you go down the cap scale. So when you talk about growth versus value, having that conversation with respects to large caps versus small caps are two completely different conversations, right? Or two completely different answers. But before we get into the growth value, I want to talk about technology, because the media loves to group tech stocks like anything that has technology in it is a tech stock. These days, pretty much anything that has every company uses technology. So they group Google and Facebook and Amazon as all part of tech, even though they represent zero weighting in the S&P tech sector. So how do you view that? Do you group those together? What kind of work do you guys do separating sectors?
Yeah, so we do look at sectors as the S&P MSCI GICS lineup creates it. I think that is helpful, but yeah, I think probably a lot of people would be surprised if they knew that some of those companies, Amazon is in consumer discretionary as an example. So we put these 6 stocks together into FanMag. So it's Facebook, Amazon, Netflix, Microsoft, Apple, and Google. And
so you include Netflix, but not Tesla.
Actually, we do have another index that does include Tesla.
Of course you do. Of course you have another index.
Yeah, it's probably a valid thing to do that. Yeah, but part of the challenge with that is, you want the history of the stock. So even though of course, these are massive stock that represent well over 25% of the S&P 500. You need them to be participating for the cap rate index to go up. But if they're the only ones going up, that's a challenge. And we found actually is if those FanMag stocks over the last 6 months have been outperforming the S&P by over 10%, since 2015, the market's gone almost nowhere. And so almost all the gains have come when they've been outperforming by less than 10%. So yeah, so you want, again, these are important stocks. You want them doing well, but if they're crushing everything else, then that probably means it's a narrow market, and which is not.
So to quote my friend Todd Sohn, shout out Todd over at Strategist, the way he says it, you want your best player scoring a lot of points, but you don't necessarily want them scoring all the points.
Yeah, that's excellent way to put it. And I think there's been some consternation over the years. Like we got this on 2018 and et cetera, when those stocks were doing really well. But then you look on the surface and you say, oh, actually, most stocks are still in uptrends. It's just they're doing great. And that's an okay condition. It's just if they're the only ones that are working, and you look at the S&P 500 cap rate index and it looks fine, you go, well, if it's just being carried by 6, 8, 10 names, that's not.
So why don't we talk about the growth value on the large cap side of things? Is this just a glorified bond trade, and that's why you're not seeing it in the small caps, or is there more going on?
Yeah, so I think there's some of this has to do with the Delta variant, stay at home versus reopening, where the large cap growth names are the ones that have benefited the most with the stay-at-home trade. And so I think that's a big chunk of why you've seen large cap growth outperform so much more than small cap growth. And so perhaps, if fingers crossed, I'm not an epidemiologist, but if the Delta variant peaks out and economy gets another leg of reopening, maybe you'd see value outperform again, particularly in the large cap space.
So here we are finishing up the summer doldrums. I've certainly felt it in the market. I've spent a lot more time in the beach than I have in recent years. I've found a lack of individual opportunities. I found more opportunities in crypto, but that's another conversation. Why don't you tell me about the good thing about this market? The great thing about the market is that we don't know what's going to happen next. Ed doesn't know. JC doesn't know. Warren Buffett doesn't know. Ned Davis. Nobody knows. So we're all on the level playing field. But if you had to write a roadmap, which I guess you do that for a living, what does that look like going into the fall, going into the beginning of 2022? How do you envision this progressing?
Yeah, so I think we need to resolve some of these breadth divergences. I wouldn't be surprised if we get a pullback. That's the biggest we've seen in a while, which is probably not too big of a call because the last time we even had a 5% correction in the S&P 500 was October of last year, which is usually you get about 3 of those a year. But we could get a pullback, and then as the market starts to focus on 2022, you look at earnings growth, not going to be nearly as strong. Same with economic growth. So maybe the headway from the market we've seen so far, this year is a lot choppier for the next several months. But then once we digest that, then I think the bull market can resume once we get deeper into 2022.
Do we need a sentiment retest? Is that a need or a want? Because I don't see many bears out there.
I think it'd be very helpful. And to do that, it looks like we're going to need more price deterioration.
Yeah.
So we have a couple sentiment composites, and our very short-term one is actually already showing some correction, but then our intermediate-term one, has barely budged. So that means that there's probably some entrenched bulls out there. And then if you look at some other data points, like the Fed produces a flow of funds report, which is quarterly, so it's not great for market timing. But last quarter, stocks as a percentage of financial assets for individuals was at a record high. It passed what it did in the dot-com peak. That's some frothy action. It'd probably be good to knock that down a peg.
What about gold? Are they ever going to buy that thing, or just going to go to zero?
Yeah, I would imagine that gold will find a bid. I wonder if there's just more opportunities for alternative asset that gold really represented for such a long time. And a lot more about crypto than I do, but I wonder if that's part of it. Even when GLD came out, people used to talk about gold mining stocks because that was the easiest way.
Right, Newmont, right.
Yeah, now nobody talks about them anymore because you just buy GLD. And I wonder if there's an aspect here where there's just competition for that alt space that could be playing into this. But no, I think should you have some gold in your portfolio as a hedge? Probably have a little bit.
A hedge for what? What are you hedging?
So, in case
profits.
What? Well, in case the market and the economy does run into trouble. And
in 2000, the stock market crashed in 2008. Gold went down too. The stock market crashed last year. Gold went down too. So if you're buying gold as a hedge, what are you really hedging?
First of all, fair point. I'd say, so here's a scenario. The Fed is printing, and the government keeps borrowing. And do I think this is going to turn into a 1970s inflation spiral? No, I don't. There's a lot of demographics and things like that are working against it. But if that happened, then that's when I think gold and other commodities would probably be big beneficiaries.
Back to our earlier point, you'll probably see it in price before the epic super inflation gets here. Like, you'll probably start to see some warning signs in price.
Yeah, so probably something like gold would start to outperform. Yeah, exactly. So on that point, right, talking about dollar, we have seen a pretty strong negative correlation between the United States dollar index and just overall risk, right? Remember, the dollar peaked right after the Trump election, and stocks did very well. The dollar bottomed in early 2018 when a lot of risk started coming off the table, particularly globally. The dollar bottomed out when stocks really started hitting the fan, and the dollar peaked last year near the lows and really got hit as risk was essentially on commodity stocks, everything doing well for a year, and the dollar was struggling in that environment.
And now we've seen the dollar kind of catching a bid over the last several months, and it's been a messy market for the environment. So do we need a weaker dollar for, this bull market to resume, if you will?
Yeah, I think the dollar probably represents security.
Mm-hmm.
And so when the dollar's doing well, that is probably like a risk-off gauge. And so if the dollar, gets the dollar to weaken, that probably does represent more of a risk-on appetite, which would be good for all risk assets in general, including stocks. So in that sense, yes, I think that's how I'd view what's happening in the dollar.
I got one a little out of left field. How much magazine cover indicator analysis are you doing these days?
Ned has had that in his book, and so what you do is you take a popular magazine like Time or Newsweek or even The Economist. Actually,
that's the best. That's my favorite.
Yeah, they're so creative for their titles, but man, and so if you get something that's super bullish, that's usually right near a market peak, and then if someone's super bearish, it's usually near a bottom. And I think the Time death of equities in the late 70s, early 80s. I forget the exact date of that.
79. I think it was fall 79, if I'm not mistaken.
Okay. Yeah. And that was a perfect example of it. Yeah, not too many people get their Time magazine in the mail these days, but there's still something to be said for that. Now, actually, what we use Google searches as a sentiment indicator now. So that's interesting how times have changed.
And kudos to you for evolving, right? Especially a guy like Ned who's been around forever, evolving as you get more data. They didn't have Google searches in the 1970s, so now we have more data and we can adapt our analysis. But the thought process is essentially the same. The philosophy is the same. And the reason I bring up the magazine cover, emerging markets have been killed, particularly on a relative basis. And The Economist, within a 2-week period, came out with 2 bearish emerging market covers. You got one where it's like a rainbow going into a trash bin. Geez Louise. And then 2 weeks later, they come out with a Chinese guy stepping on all of the companies, essentially, right? Like putting capital, like just 2 bearish emerging market covers as emerging markets are getting killed. That
would be amazing if it were. Now, I'll tell you, our trend models still don't like emerging markets, but sentiment toward them has certainly gotten more and more negative. And some of it's probably good reason for it. I think one of the challenges for it, particularly if you use something like the MSCI Emerging Market Index, which is like, I think, over 40% China.
Yeah.
So you're kind of like, it's not exactly the most diversified index like it had been in the past. But yeah, I think those sort of things do tell you that sentiment towards EM is getting pretty one-sided.
What do you think people are missing here before I let you run? What do you think people are missing that you just think is getting ignored? I'll open it up to any asset class, any indicator. What's got your attention these days that you think is a little quiet?
Yeah, first of all, we covered a lot, but I'll throw one more out there, and that is dividend stocks have really struggled, and I think with interest rates being so low, there just hasn't been as much interest in them, and people forget about them. But one of the things that's happened with dividend stocks, the highest dividend yielders, is that there's been a lot of companies that you don't think of as traditional dividend names, more cyclical stocks have been put in, have gone into those indices. So if you're, say, just buying an ETF or a fund that's just doing a dividend screen, and just said, I'm going to buy top X stocks based on dividend yield in the S&P or other benchmark, you may not have it. You may not own what you think you own, but I think there could be a case to be made, particularly once you get out of the first year of a bull market. Dividend stocks don't do very well because they tend to be fairly defensive,
right,
low beta names. But maybe there's a chance to take a look at them. Just know what kind of stocks are in whatever dividend fund you're buying. So make sure you're buying the kind of companies you want to own for that. So that's something that I think is flying a little bit under the radar. It's getting a little bit more of a better environment for those names.
That's really interesting. We've done a lot of work in the space, and what we've noticed, what we really like is the stocks that continue to raise their dividends every year versus those with the highest yields, because in a lot of cases, the ones with the highest yields, it's because the price has gotten slaughtered. So it increases the ratio. And if you're ignoring the ones with low yields, you're penalizing the company because the numerator, in this case, price, has done so well, which, as you and I are well aware, is not a bad thing. So we're more interested in the consistent dividend increases every year for a period of time versus the dividend itself. How do you feel about that?
Yeah, I'd agree. Yeah, and I think we've done. It's been a few years since we did the study, but actually, if you cut out the top 5% by dividend yield, like those are the ones that are cheap for a reason. Yeah, that the market's figured out that the dividend is really at risk.
Non-existent.
Yeah. It looks like a good dividend yield, but you ain't going to get that dividend. But yeah, dividend growth is a really good indication of management team's confidence, because if you're a CFO, pretty good gig, no heavy lifting. They want to keep their jobs. And the best way to get fired if you're a CFO is cut your dividend. So you're not going to raise it unless you really feel good about it.
Yeah.
And so we have an index going back to the 70s that show companies that grow their dividends, outperform the broad market, certainly companies that don't pay dividends, even companies that pay a dividend that haven't increased it. So dividend growth is, if you want to get into quant factors, that's a really good one to use.
Yeah, so you've got the old school dividend aristocrats that have raised their dividends every year for 25 plus years. Think J&J, Coca-Cola, Procter & Gamble, stuff like that. So we look at the contenders that have raised their dividends between 5 and 9 consecutive years. We call them the future aristocrats, or the little aristocrats, to quote one of my friends, Josh. The young aristocrats or the future aristocrats. That's our bread and butter. That's where we're looking.
Yeah, okay. I haven't studied that. That's a really interesting idea, because, I think, if you look at, a company that's raised a dividend for 25 years, how mature is its business? So you can make an argument one way or the other on
You're
that.
Probably not early.
Yeah, exactly. Yeah, exactly. But yeah, a company that's clearly committed to it, but maybe earlier in its company maturation process. That's an interesting concept. Yeah.
Yeah, I wish I could tell you I was smart enough to have come up with that on my own, but these are some old concepts. I believe they call them I forget, because you got the contenders, the challengers, and then the aristocrats. I forget which one is between 5 and 9 and which one is between 9 and 25. So we just call them the young aristocrats or the future aristocrats, and we sort by proximity to new highs, and we've had some great winners. Goldman Sachs recently on that list, NVIDIA as well. You'd be surprised by some of the names that are on that list.
Yeah, it's an interesting concept. Yeah.
Totally. Listen, Ed, I really enjoyed this. I had a hunch that I would, but I did. I have so many questions. I'm such a big fan of your work and all the stuff that you and your colleagues are doing. So thank you from the bottom of my heart for being here.
Oh, thank you. I had a great time. Enjoyed just chatting about the markets and philosophy and where things can go from here. Good stuff.
For all you guys listening, I'll put in the show notes how to follow Ed and all the work that he's doing on Twitter. Ed Clissold, thank you for being here on Technical Analysis Radio. Let's do it again. And that's today's episode. Thanks for listening. To catch up on all previous episodes, go to allstarcharts.com/podcast.